Hello and welcome to another Trades and Tutorials video. This is Jeff Bish, president of MarketGauge.com, and in this video I'm going to share with you a really cool volume-based indicator that enables you to quickly figure out whether you should have a bullish or bearish bias based on what volume is doing. So before I get into that, let me just make sure that anyone who's just stumbling on this in YouTube, please subscribe to our channel, and if you use Twitter, you can follow us at MarketGauge and also at Market Minute. And finally, we've got a lot of other videos just like this at marketgauge.com/tutorials. So please visit us there. And finally, if you're not already seeing this video in HD, please go to your settings in the lower right hand corner and change it to HD. It'll be a lot clearer. I think you'll like it. All right, so the idea here is we're looking at the concept called accumulation and distribution in a way that Investors Business Daily popularized it. And accumulation distribution is simply looking at days when if the market goes up and you have volume that is greater than the prior day, that's considered an accumulation day. If the market price goes down and you have volume that was greater than the prior day, that's a distribution day. So let me see if I can just give you an example here. Now, in the chart that we're looking at here, this is just the volume for the SPYs, and if the SPYs went down on the day, then it would be a red bar. If the SPYs were up on the day, it would be a green bar. That's not the same thing as accumulation distribution. So in order for it to be accumulation distribution, the volume actually has to be greater than the prior day. So in this particular bar, the market went down and it closed down and the volume was greater than the prior day, so that would be a distribution day. In this particular day, the market closed up, but the volume was less than the prior day, so that's not an accumulation day. Likewise, this green bar, the market went up, but the volume was less than the prior day, so that's not an accumulation day. Here again, the market went up, but the volume was less than the prior day. That's not an accumulation day, right? It's not until here, and it's really a light one, where you have an up day and the volume is greater than the prior day. That's an accumulation day. Right now, on the flip side of that, or let's take a look at the down days. So this is a down day and the volume is greater than the prior day. That would be a distribution day. This is a down day and it was lower than the prior day. That's not a distribution day. All right, get the idea? Here's a down day and it's greater, so that is a distribution day. All right, so that's how each individual day works. Pretty straightforward, especially when you get the hang of it. But looking at this every single day, day by day, and trying to figure out what's going on might drive you nuts. And what you really want to look for is, over the last 2 weeks, have there been 3 or more of either accumulation days or distribution days? And if there have, then you would be biased towards the market going in that particular direction. Right? So the indicator that I have set up down here is exactly that. It's a sum of the accumulation days in green and the distribution days in red for the last 2 weeks. And the blue line is the 3 level. All right? So essentially, if you're hitting that 3, or even more strongly going through the 3, and now you've got 4, then you want to have a heads up. And the heads up would be that you want to follow the market if it continues to go in the direction of accumulation or distribution. If you have a situation where the market's going up and you're seeing 3 or more distribution days, that doesn't necessarily mean the market has to go down right away, but once it starts to turn down, you want to be very cautious, right? If the market is going down and you're seeing accumulation days, that doesn't mean the market is going to go up right away, but it does mean that if the market continues to move higher, you want to have the bias towards following it. Now, as a result of it only being 3 days, you can have situations where this will flip rather quickly. So you want to keep in mind that you're following the direction of price action, not following the direction of volume. Let's take a look on a big picture of what we mean here. So I'm scrunching it up just so we can kind of see the areas. So here's an area where we'll start here. You can clearly see that coming off of this kind of distribution level, the market worked its way down here, and then in here we can see that we've now got some real strength behind the market. So in here you'd start thinking, you know what, this was potentially a real bottom. If it continues to go higher, I want to follow it, right? So let me just switch to this. And then when we get to negative days in here, you want to be cautious if the market heads down, but it doesn't necessarily mean it has to head down. In this case, it continued to move higher, and you had these warnings here that even though you were moving higher, when the market had down days, it was doing it on higher volume. So as soon as the market starts to head down in here, you know you've had these warnings. All right. Meanwhile, you've had some days pushing higher. It's kind of balanced but warning, right? Now the market sells off, and not necessarily surprising, once it starts to roll over, you had the warning. Now in here you've got accumulation days, but the market really doesn't get going to the upside. So you're waiting for the market to push to the upside. Doesn't really happen. Now when I say it can flip quickly, on this particular day here you've got a -3. So here you've got a really early and quick warning that when the market's going down, it's doing it on higher volume. You should watch out. And then once it starts to fall, you can see it goes to a 4 here, and you get another drop. When the market bounces in here, you can see we never got anything convincing in terms of accumulation days. We got 2 here, but the market never follows through on the upside, and then it goes right down into distribution days. So as you look at the ebbs and flows of the distribution days down here, not very convincing to the upside. The market doesn't break. And then as soon as the market shows any weakness, it's right back down to distribution days. All right? And that's the way it has been all through this period. So we got a couple accumulation days in here, but then it was never really able to move forward to the upside, and we're right back into negative days again. And if you look at the big picture of this chart, that's really been the picture since the beginning of 2015, actually the end of 2014. So how are you going to use this if you don't have the chart? Well, one, you could go to our little big view section and you can see the accumulation number. And 2, you can just take a quick look at the chart when it's at a critical area and count back and see how many days has the volume been positive or negative relative to the prior day. Hopefully we'll get this chart up on the site at some point so you can just watch it. But in the meantime, you can see the accumulation or distribution number right here on our site. So I pulled in our site, and if you go to resources, little big view, you'll end up here. I'm at market overview, and if I scroll down, you can see here's the number of distribution days and accumulation days. Now if you get 4 or 5 over a 2-week period, that's really bad, but what I just described to you is even if you hit the 3 number, that's a heads up that you want to follow the market in that direction when it goes in that direction. So 4 or 5 distribution days, that means when the market heads lower, you want to anticipate that the momentum on the downside could continue. All right, so it is really a simple calculation, but it is incredibly effective. And if you'd like to learn more about kind of easy ways to time the market, be on the right side of the market, we are doing a webinar this Thursday, and I'll put a link in the text to that right above this video. So hope we can see you there, and hope this helps, and I'll see you in the next video.